Thank you for coming out. Hello, Peter. This is Peter Hofstra. We have on the line, Peter is the CIO and Senior Portfolio Manager at CI Investments. He manages the Harbour team.
So I'm Chief Investment Officer and Senior Portfolio Manager, right? CI's got their name and nomenclature for how they identify people, and technically our group is called Harbour Advisors. That's
How are you doing this morning?
I'm doing well, all things considered. How are you, Simon?
Very, very good. Very, very good. Let's see. Thank you very, very much for joining me today. What I'd like to do is kind of focus our talk on a couple of different things. I'd like to talk about the macro environment, what's going on out there, what's happening with the coronavirus. I'd also like to talk about your fund and your investment strategy in particular as well. Now, I guess if we could start off with what you do exactly. So how much money does your team manage, and what is your role exactly?
Yeah, so we manage about $5 billion across a number of different mutual funds, very North American centric. So run some Canadian funds that would have a very restricted foreign content, as much as 25%. We run the North American Dividend Fund, which gives us the most freedom. We can be 100% US or 100% Canadian there. We also run a pure US product, which is really an in-house for the high net worth grouping. So it is more or less of a model portfolio. So very North American driven as a group, managing a decent amount of assets. So my group there is to really coordinate the research effort, and as the senior portfolio manager, ultimately responsible for stock selection, what gets in the portfolio and the performance that we generate.
It's really great to be able to talk to you and to have access to you, and thank you for your time. In this environment, again, I wanted to split this up between what's going on out there and then actual what you're doing.
Sure.
This is very much the tale of two cities as far as everyday investors are concerned. There's what's going on in investment markets and what's going on for everyday people and what they're seeing. Could you give us a bit of an overview of what you think is happening in markets and what you think will impact Main Street versus Wall Street, as we would say?
Yeah, and it's a good way to think about it, Simon, because the market tries to be forward-looking. So as often as you're trying to look at current events, but look beyond those, and that creates a lot of volatility in the market because we're in pretty unprecedented times. And so as we're trying to guess, what the next 3 to 6, 12 months look like, that's obviously a challenge. So let's talk about a little bit where we are, right, and how we see this current environment. And we're really part of call it a grand social and economic experiment that's happening right now. That we've never seen this, where governments around the world have collectively decided we need to shut the economy down because we have to prevent people from coming close to each other. And the only way to do that is to basically impose a lockdown. And so we go back and say, why are they doing that? And so we think, why are we doing that? Because that's important to think through. And how do we come out of this, right? How does the world come back to something that we might call normal? One, it's particularly contagious, and they're trying to really decipher why, but one infected person seems to be able to infect quite a number of others. They think that at least 30, maybe as high as 50% of people who get infected never show any symptoms, but those people still might be contagious. So it's a virus that's very necessarily hard to track and contain. For the young and otherwise healthy, it seems a majority get very minor symptoms, if any symptoms at all, but there is certainly a percentage of the population that is very susceptible to generating quite extreme symptoms, even to the point of threatening their life. And so what the challenge is, because it's so contagious, that it grows so exponentially, that even though there's a small percentage of the population, typically the elderly or otherwise, have a compromised immune system, that's a big enough number that it would overwhelm our care facilities. And that's been a challenge. And that was the Italy experience, where literally medical staff are having to send people home to die in their home because they were refused treatment. And no one wants to create that humanitarian crisis, right, with their own population in our own backyard. And so what governments have done is said, we need everybody to help here. It's so contagious, we're probably all going to get it at some point, or certainly a majority of the population is going to get it. But we all need to help to flatten this curve. If we can manage how many get infected at any one time, we have a better chance at managing how many require hospitalization. So we're all being asked to help with that. And then in the background is the investment to say, we need to ramp up our care facilities. We need to ramp up our ventilators. It's a respiratory virus. For those that are interested, The coronavirus was first viewed under a microscope back in the 60s when they finally had microscopes powerful enough to look at that down to the dimensions of a virus. And it has spikes on its surface. So they thought that it was a crown. Turns out it's a sphere with spikes on it. Those spikes latch to cells in our lungs very efficiently, kind of a hand in glove. There's a protein on the surface of cells in our lungs. So that's why it's a respiratory virus. But that means if you get it, you need that ventilator to really help you, assist you with your breathing. And that's the best treatment we have as your body ultimately in your immune system responds in a way that it can defeat the virus. So that's the best treatment we have today as we work on antiviral and ultimately on a vaccine. But those are the things we need to think about of how we got to where we are economically and how we're going to get out of this. And so one may just be if we have enough care facilities, maybe we can all get back to work.
One of the things that you're talking about is having enough facilities, having enough respirators, having enough protective equipment. That these are really the things that are desperately needed. This is, when we think back to World War II, for example, and we think about, building bullets and bombs and the massive push to make production of things that were needed. I mean, how well equipped are we today to be able to actually have that push go, and how fast can we ramp up production of all of these things that we really need?
Yeah, and there's different degrees. The PPE, the personal protective equipment, can be ramped up fairly quickly. Even Canada Goose said they were prepared to convert some of their manufacturing. So those fabrics are abundantly supplied. The masks, there's certain ratings masks that are important for medical staff. It's more the ventilators are a bigger challenge. So to think that a GM can stop making cars and start making ventilators the next week and have production going in a month, that's not likely. So maybe those are some of the headlines that are out there that are probably not realistic. Our better bet is to expand production of those that have the capability and the expertise to make a ventilator. There is some science behind making them. You can actually get sick from misused or misbuilt ventilators, so it's important that these things be certified and built properly. But I think those that know how to do it with the proper investment can ramp up quite quickly. The capacity is there to ramp up quickly with the ventilators, using those that have the expertise to do it. As I said, they've reached out to governments and said, give us the order, we can respond, and we verified the supply chain has the components. So I think the capacity is there to respond. Everybody's
sequestered at home. For those of us that are lucky enough to be able to work from home, this is where technology is able to really, really help us. What about everyday people? What are the thoughts about Main Street and the impacts on people that are, that are in the hospitality sector, that are perhaps, they've got restaurants or landlords or Airbnbs, whatever it is that individuals might have been running as their own personal businesses? What are going to be the impacts on them? And that would be in Canada, and then kind of in the US, we're going to be slightly different, but similar, I would suppose.
Yeah, and okay, there's no doubt about it. It's going to be tough. I mean, we're in a recession. However you define recession, normally it's 2 quarters of negative GDP. I wouldn't worry about the definition. The fact is this is going to be economically impactful. And governments know that. What we're trying to set up for is a rapid recovery as possible. And so that's the response you're seeing. But know that, the magnitude of the response from central banks as well as governments, should be suggestive of how big they expect the problem to be. There are these fiscal plans are 10% and more of GDP. This is bigger than the great financial crisis as far as the response. And it really is, and it's a number of different measures, but it is for everyone who you're talking about, that Main Street worker who has been asked to stay home. The company, without any revenue, can't afford to pay their employees. And so then there's different mechanisms to ensure that at least those people continue to have an income. And so the extent that we can keep the economy on life support by having enough income out there that people can be spending, and then ultimately ramp back extremely quickly, is what we're setting up for. But there's no question the short-term impact on people is going to be quite radical, and how their lifestyles are going to change, and having no job to go to for a period of probably at least 6 weeks.
So one of the things that you just mentioned is that government aid coming through what we know to be quantitative easing and kind of money creation that is being put into the economy. That is not something that we're going to be able to directly profit from at this moment, but this is something that is going to speed the recovery up once the recovery happens. Would that be your view?
The economy is a feedback loop. And so if you think if we're all auto workers and we're afraid, we're thinking of buying a new car, but we're afraid we might lose our job. So none of us buy a new car. Car sales drop, right? There's enough of us out there, like car sales drop and we all get laid off because car sales were poor. And economists and central banks know this. So one thing they want to do is make sure that they keep some confidence in the system. If there's confidence that people are going to have future income, they'd be more inclined to spend today, and that helps keep the economy afloat. So I think to answer your question, Simon, there's two dimensions to this. One is to give people the assurance it's okay to spend today, right? To the extent that you can, go out to the drive-through, do your Amazon order, whatever it is, because your job is going to be there in the future, and we're going to keep some income flowing to you today, and we'll help you manage your expenses by mortgage deferrals and rent deferrals and all of those things. We want to get everybody back to a state of normalcy as quickly as possible. So we want to manage how low the drop is in spending. So it's to try to make sure that people have that sense of confidence that they can function as much as possible in the world they have today. And then, of course, you're right, to ramp out of this as quickly as possible.
Let's see. Now, as far as market activity is concerned, we've seen unprecedented volatility. Last week or 2 weeks ago, I don't know, 2 years ago, it feels like every day is forever here. We saw the markets kind of hit a low and really aggressively rebound when all of this federal government stimulus packages were passed in the United States. What do you see happening in the markets going forward?
Yeah, and so there's we should expect some volatility to continue. Maybe not at the magnitude that we saw early in this, but I think that the headlines, certainly in terms of caseload and mortality rates, are yet to peak in North America, and certainly in the U.S. you can see they're bracing their population for what could be fairly dramatic numbers. And again, the question is the market looking through that at this point as a future-looking entity? And so it's difficult to know how it might respond to that. But we do expect some volatility to continue. Do we retrace that exact low? Again, we think don't try to pick the bottom. A lot of money is lost trying to pick the bottom. We won't know when it's in until 6 months afterwards, and you'll look back and say, oh, okay, that's when it finally formed. What we do know is there's good opportunities, but I assume we'll talk about that as we go. So I would think it's going to be rocky for a little while, maybe not to the magnitude that we saw.
Okay. I think that's a great segue to opportunities. Talk a bit about where you see them. And actually, let's talk about opportunities more than your fund directly. Where do you see the best opportunities playing out today? Where do you see the biggest risks as well?
Yeah, good question. So let's start higher level and we can sort of drill down. So number one, if you look at a 100-year chart of the stock market and there's no news or anything overlaid, take the dates away and just say, put a pin in where you wish you would have bought, right? And then you put your pin ins and then you put the dates in and put the news stories in. And it's at those times of high stress, right, of high impact that, something fairly extreme is going on where the great opportunities to buy. So from a high level, we say it's a good time to get into equities, and we weren't saying that 2 months ago. 2 months ago, we were concerned about valuations. We were moving to a more defensive stance with the portfolios, and now that's changed pretty radically. When you get 30+% drops in the market, opportunities can start to emerge, and they're not everywhere yet. And so what we're seeing is companies that we never owned before, like an Amazon, for example, all of a sudden becomes quite affordable. So here's a company, that's got a tremendous growth prospect, was always a growthy name in terms of who might the investor base be, suddenly comes into a valuation that start to make sense for people that are more conservative on how they approach valuations and the price they're willing to pay for a company. And so a lot of those things start to happen. And Abbott Labs, which has a big diagnostics division, and despite the fact that it probably benefits from this, just in that pure sell-off, and we can talk about the nature of the sell-off, but those sort of unique opportunities get created. And so those are the things we're looking at. There's other names that have not necessarily fallen as much, that have not quite come into what we think is an attractive price range. But I would say a tremendous number of stocks that we thought were always those elite, great businesses you'd love to own, but always seemed expensive in the market we come out of, are suddenly coming into our sites and starting to look pretty interesting to us. It's important to understand where that comes from. And the selling, as we looked early on and we watched it, that initially the selling was quite selective. So it was toward those, retailers that are brick and mortar focused. It's restaurants, right? So it was all the things that you think are going to be directly impacted. Those started to sell down first, and the Costco's and other things where people thought, well, they'll do well because people are stockpiling. All of a sudden, everything collapsed. And that's when the market really got indiscriminate. And that was from a number of things. So that can be margin calls, right, where people have borrowed to invest, right? And as their investments collapse, they need to refund those accounts. So they have to sell the things that have held up. It's ETF selling, so people that just own index funds, and they need to sell those if they want to take money out of equity. Just creates the entire S&P 500 or the entire TSX composites being sold. So the selling really did get indiscriminate, which is sort of what creates opportunity. Names like a Johnson & Johnson or an Amazon and those types of names that are often very difficult to buy at attractive prices.
Mm-hmm. So what's the feeling amongst your peers when it comes to where we are, whether or not you should be buying or selling or being fearful or hopeful?
So what we found in March, and where some of the rally and the support came from, was pension plans. So, they would have a balanced strategy. So we need X in bonds, X in real estate, alternatives, and we have our equity mix. Equities are the most directly marked to market. So as equities fell down, they were under allocated. And the pension plans have all said, we need to go, and they would call their equity managers and say, the money's coming your way. We're going to bring equities back to target, and we want it invested and invested now. We think this is an opportunity, let's go. And so when you look at a lot of that buying activity, that was long-only pension plan money those are real buyers who saw attractive bargains and wanted money put to work in equities. The retail mutual fund managers are a little more cautious on average. So they're more trying to pick the bottom. They're more thinking that we need to manage volatility for people. So a lot of them are holding a bit more cash and trying to see if this volatility is going to subside a little bit. So it's a bit mixed, depending on I would say your time frame, how far ahead you're looking. The pension plans have that longer term view, and I would say some of the money managers that are running mutual funds are being a little more cautious here.